Today, we're talking about the Lithium Triangle. But we're not going to get caught up in the hype. Instead, we're going to build a really clear framework for how to think about risk. You've probably seen headlines just like this one, right? They're designed to make you feel a sense of urgency, maybe even a little panic. And look, for a news story, that's fine. But when you're an investor, drama can be a really dangerous thing. So let's just slow it all down and cut through that noise. So our goal here today is not to pick the next hot stock. Nope. It's to build a mental model so you can actually understand what the real risks are when you hear about a commodity like lithium getting all this attention. Okay, first things first, what exactly is this place that's always in the news? So the Lithium Triangle isn't a country. It's really more of a geological hotspot. It's this high-altitude region of massive salt flats that stretches across parts of Argentina, Bolivia, and Chile. You can basically think of it as the world's epicenter of white gold. And here's why it's such a big deal. A jaw-dropping 56%, more than half, of all the world's identified lithium resources are packed into this one single region. Now, when the future of electric cars and massive battery storage systems all depend on this one ingredient, well, that kind of concentration is pretty much guaranteed to make some waves. Right. So this intense concentration of lithium is really the perfect foundation for that dramatic war story that we hear so often. Let's break down exactly how that story gets built. So what's the recipe for this story? Well, you start with the absolutely explosive growth in demand from EVs and battery storage. Then you mix in the fact that lithium-ion batteries are just totally dominant. I mean, they're in everything. You add a dash of fear over that supply concentration we just talked about, and then you top it all off with a good old-fashioned geopolitical scramble, where you've got the US, China, and the EU all fighting for a secure piece of the pie. Put all that together, and you have the perfect storm for some really dramatic headlines. But the story actually goes a layer deeper. See, it's not just about who can dig this stuff out of the ground. It's about who can process it into the battery-grade material we need. And this chart reveals the real bottleneck and a huge source of that geopolitical tension: China's incredible dominance in refining. So even if a country mines its own lithium, a lot of the time it still has to get shipped to China to be turned into something usable. That's a massive piece of this puzzle. So this is the crucial takeaway right here. All of those things we just talked about, they create a very compelling story. It's logical, it's easy to follow, and it feels really urgent. But you have to remember, a good story is not the same thing as a good trading signal. And that right there brings us to the absolute core of this explainer. We need to separate the geopolitical story from the actual financial reality. Because the real risk for an investor, well, it's often not what the story makes you think it is. You see, the story on the left, that sells you a risk of scarcity, the idea that a war is going to break out and the world is just going to run out of lithium. But the market on the right tells a totally different story. The actual risk that has consistently wiped investors out is just brutal price volatility. It's not about the lithium disappearing, it's about these massive price swings caused by supply gluts and shortages. You know, the classic boom and bust cycle of any commodity. I mean, just look at this price chart. This tells the real story. While the headlines back in late 2022 were screaming about a permanent shortage, the price was peaking up near $80,000 a ton. Now, anyone who bought into that story got absolutely crushed as the price collapsed all the way down below $15,000 just over a year later. The danger wasn't a war. It was a classic market cycle where supply finally caught up with and even overshot demand. The risk was volatility, plain and simple. And here's the key insight you have to get. Geopolitical events like a country nationalizing a mine, those things take years to actually impact the physical supply of lithium. But market prices, they react in seconds to fear, to greed, and to shifting expectations. Understanding that time lag is really the secret to avoiding the most common traps that seem to catch beginner investors in this space over and over again. So what are these super costly mistakes? First, chasing the headlines. By the time a big newspaper runs a story about a new lithium deal, you can bet the professional traders have known about it for weeks, and the price already reflects that news. You're probably the last one showing up to the party. Second, assuming a direct correlation. The logic seems simple, right? More EVs sold means lithium stock prices have to go up. But it's not a straight line. The market can get flooded with new supply from miners trying to cash in, and that can crush the price even while EV sales are still climbing. And third, and this might be the most important one, is just ignoring cyclicality. Commodities are not tech stocks that just go up forever. They move in these violent boom and bust cycles. And if you forget that, that's how you end up buying at the absolute peak of excitement and selling in a total panic at the very bottom. And this is the real heart of the matter. Most of us react to the emotional pull of the lithium war story, not the slow, often brutal reality of the market's timeline and its price cycles. So how can we actually use this knowledge in a constructive way? Now, this isn't advice, but it is a framework for how to think about this kind of risk inside your own portfolio. It really just comes down to a few key behaviors. First, position sizing. Are you putting 1% of your portfolio into a volatile theme like this, or are you putting in 20%? That decision completely changes your risk exposure. Second is diversification. Are you balancing a high-octane bet like this with other, less correlated things that can maybe cushion the blow when things go south? And finally, expectation management. You just have to go in with your eyes wide open, knowing that this is a high-risk playground and that deep, painful corrections, they aren't just a possibility, they are a feature of this market. At the end of the day, this isn't about making some all-or-nothing bet on lithium. It's about looking at its volatile, cyclical nature and making a really clear-eyed decision about where an asset like this might fit, or maybe where it doesn't fit, into your long-term plan. And just to be perfectly clear, none of this is investment advice. It is simply a way to help you think through risk on your own terms. Everyone is, of course, free to make their own investment decisions. So I'll just leave you with this to think about. Now that you can see the difference between the headline story and the market's volatile reality, how does the whole lithium story change for you? If you appreciated this kind of calm, structured approach to a really complex topic, go ahead and subscribe to FinAnatomy for more. Thanks for joining me.